Everyone knows that to make money on the stock market, you need to buy a stock, wait, and then sell it for a higher price. But did you know that you can make money from a stock decreasing in value? If that interests you, stick around for this video. How's it going, guys? Ryan here and welcome to another investing video, and today we're talking about the concept of short selling. And as I touched on in the intro, this is a way for you to make money off stocks when they are decreasing in value. But before we get into that, guys, please remember to like this video. It helps me out so much with the YouTube algorithm, and subscribe for more investing, stock market and wealth management content. I'd love to know your thoughts in the comments section below about short selling and whether or not you've done it before. So guys, without further ado, let's get straight into the video. So typically when we talk about stocks, we talk about going long. So buying a stock, waiting for it to increase in value and then selling it for a profit, or holding onto it for dividends and the like. But have you heard of the term going short, also known as short selling? Well, effectively this is where you want the price of a stock to decrease in value in order to make money. This is quite a bizarre concept when I first heard about it, and it's quite complicated to explain. So I'm going to open up this diagram and explain it to you using visuals, as it is the easiest way in order to wrap your head around the concept of short selling. Welcome to the short selling diagram, also known as going short. In this process, there are three key parties. You've got your broker, you've got your short seller, so typically yourself, and you've got the actual market. And there is effectively four key stages to short selling. The first of which is the broker lends the short seller shares. So the short seller, or the investor, if you will, borrows shares from a broker. That means they effectively do not own these shares. The next stage is they sell them immediately on the market for current value and wait. Now, what they're doing is effectively waiting for the stocks to drop in value. That's the whole point of short selling. You're predicting that the stock you've just sold is actually going to decrease in value. And when it does decrease in value, that moves us to step 3 in the bottom right there. You buy the shares back. And effectively, when you buy the shares back, you're hoping to have bought those shares back at a cheaper price. You then return those borrowed shares to the broker and pocket the difference. So you can see at the bottom, as I mentioned, there are two key outcomes. The first of which I just touched on is short seller buys back for less and pockets the difference. That is effectively how you're making money here. The second outcome is that the short seller buys back for more and owes the difference. So effectively what happens there is essentially the stock you have sold increases in value, and then you've sold it for a loss. So it's effectively the opposite process to going long, and that's why it's called going short. If you're like myself, the first time I heard about short selling and it was explained to me properly, I was absolutely amazed, because I just realized there is a completely new opportunity for making money on the stock market. Now, as you know, every new opportunity comes with its benefits and its risks. So let's touch on those right now. So the main key benefit of short selling is the fact that you can make money on stocks that are decreasing in value. If you know that the market is going to drop, or an individual stock's value is going to drop for whatever reason, or even an industry, you can short whatever stocks that the broker is willing to lend you in order to make a profit. So if you knew the gold price was going to go down and you thought Northern Star, which is a big gold mining company, is going to decrease in value, you could approach your broker and say, hey, I'd like to short sell Northern Star, and they'll lend you a number of shares in order to do that. And effectively that is the key benefit. Not only can you make money on the way up, you can make money on the way down as well. Moving on to the risks with short selling, and there are two key risks that you need to be aware of before you get into short selling. The first of which is that the broker can call back their shares at any point in time. This effectively means that you have to buy back those shares immediately and hand them back to the broker at whatever price point. Basically, if the stock has increased in value, you owe the difference there. Hopefully, you're not in a position where this has occurred and you can make a profit by buying them back at a cheaper price, but in this situation, you do not have a say. The second key risk is that you can effectively lose an infinite amount of money. So let me explain briefly. If you invest in a stock in the typical way where you buy a stock, it can decrease to a value of $0 and you lose whatever amount of money you've put in. Short selling, on the other hand, is the polar opposite. Effectively, what happens is, let's say you want to short $5,000 of a stock. So effectively, you borrow that stock and you sell it immediately on the market for $5,000. Now, let's say this stock goes up 200%. That would effectively mean that the stock's value, or your portion of that stock's value, has increased by $10,000, which is a lot more than what you initially put in. And if you actually think about it, this stock could effectively go up to whatever value possible. It could be infinite. And basically what that means is you could lose an astronomical amount of money if you're shorting a stock that actually increases in value quite significantly and quite sharply. And if the broker comes back immediately and says, hey, I'm calling back my shares, you have to buy them back at the current market price and you've just lost a huge amount of money. And in my opinion, that is the biggest risk with short selling, and why it is something that beginners probably shouldn't do. Even advanced people probably shouldn't dabble in it unless you really understand and you're really sure that a stock is going to decrease in value. There is also a concept known as short squeezing. And this is effectively where you have a stock which has a lot of individuals or funds shorting that stock. And you would have heard in the media probably recently this term being thrown around. And basically these people shorting the stock are squeezed out of it by a large volume of people or an individual buying lots of shares of that stock, causing it to increase in value. And then what happens is those brokers, as I mentioned before, will call back their shares. And that means those companies or those individuals who are shorting that stock effectively have to buy back the stock at the current market price. This also keeps driving the value of the stock up because effectively they act as buyers of that stock as well. So you can see a lot of nasty things can happen. A lot of people can get caught out when they're shorting shares. I hope that was a clear explanation of shorting and the benefits and risks involved. I'd love to know your opinion on shorting and whether or not you've performed it yourself before and if you made or lost money in the process. And with that, guys, I'm going to wrap up today's video. If you did enjoy it, please remember to leave a like. It helps me out with the YouTube algorithm quite a lot, and subscribe for more investing, wealth management, and stock market content. And with that, guys, I hope you have an awesome day. I'll see you next time. Cheers.